In just a few years, Meta spent more than $30 billion chasing a digital future that barely anyone wanted. What was supposed to be the next version of the internet became one of the most expensive tech gambles in history. This is how Meta's Metaverse dream turned into a financial nightmare. Zuckerberg's all-in bet on the Metaverse. In 2021, Mark Zuckerberg shocked the tech world by renaming Facebook to Meta. The message was clear. Social media was no longer the future. The Metaverse was. Zuckerberg believed that virtual worlds, digital avatars, and immersive VR experiences would replace smartphones as the next major computing platform. This wasn't a side project. It was a full-scale pivot of one of the world's largest tech companies. Internally, teams were reorganized, priorities shifted, and massive budgets were redirected toward Metaverse development almost overnight. Reality Labs became a money pit. To build the Metaverse, Meta relied on its Reality Labs division, responsible for VR headsets, AR glasses, and virtual world software. From 2020 to 2023, Reality Labs reported operating losses exceeding $30 billion, with some individual years losing over $13 billion alone. Despite this spending, revenue remained relatively small. The division generated only a few $billion in sales, mainly from Quest headset hardware, which was often sold at or near cost. Investors began questioning how long Meta could keep burning cash without meaningful returns. Horizon Worlds failed to attract users. Meta's flagship Metaverse platform, Horizon Worlds, was supposed to be the foundation of its virtual universe. Instead, it struggled to keep users engaged. Reports revealed that most users stopped using the platform within weeks. Even internal data showed low daily active users compared to Meta's massive social media platforms. The graphics were criticized as outdated, avatars looked cartoonish, and the experience felt empty. For a company that mastered engagement on Facebook and Instagram, failing to retain users in the Metaverse was a major red flag. The hardware problem no one solved. Another major issue was hardware adoption. Meta invested heavily in VR headsets like the Quest 2 and Quest Pro, believing widespread adoption would follow. But VR remains a niche product. Headsets are uncomfortable for long sessions, isolate users, and don't fit naturally into daily life the way smartphones do. The Quest Pro, aimed at professionals, launched at a high price and sold poorly, forcing Meta to slash prices. Without mass hardware adoption, the Metaverse ecosystem never had a chance to grow. Timing was terrible. Meta's Metaverse push came at the worst possible time. As the company poured billions into VR, the global economy slowed, inflation surged, and tech stocks collapsed. Meanwhile, Apple's iOS privacy changes severely hurt Meta's advertising business, cutting billions in revenue. Investors expected Meta to focus on fixing its core business, but instead, the company doubled down on long-term Metaverse spending. This disconnect caused Meta's stock to crash by over 70% in 2022, wiping out hundreds of billions in market value. Employees didn't fully believe in the vision. Internal reports suggested that even Meta employees were skeptical. Many avoided using Horizon Worlds themselves. Some teams complained about unrealistic deadlines, unclear goals, and constantly changing direction. Building a metaverse requires not just money, but strong internal belief and long-term cultural alignment. Instead, Meta faced morale issues, talent loss, and internal confusion about whether the metaverse was truly achievable in the near future. Consumers didn't ask for this. One of the biggest mistakes Meta made was assuming people wanted to live in virtual worlds. Most users were perfectly happy scrolling Instagram, watching videos, or messaging friends. The metaverse required users to change behavior entirely, wear headsets, and spend time in digital spaces that offered little practical value. Unlike smartphones, which solved clear problems, the metaverse felt like a solution in search of a problem. Without strong consumer demand, adoption stalled. Competition wasn't playing the same game. While Meta spent billions on the metaverse, competitors focused elsewhere. Apple invested in high-margin hardware and AI. Google doubled down on search and cloud computing. Microsoft approached the metaverse cautiously, integrating VR into enterprise tools rather than consumer worlds. When Apple later introduced its Vision Pro, it framed it as a spatial computing device, not a social metaverse. This made Meta's approach look outdated and overly aggressive by comparison. Shareholders finally pushed back. By late 2022, Meta's investors had reached a breaking point. Years of explosive growth had trained Wall Street to expect constant revenue expansion and rising margins, but Reality Labs was doing the opposite. Every earnings call revealed billions more in losses, with no clear timeline for profitability. Shareholders began openly questioning Meta's leadership strategy, especially as advertising revenue slowed due to economic pressure and Apple's privacy changes. Meta's stock collapse amplified the criticism, turning internal ambition into external pressure. Activist investors and analysts demanded accountability, arguing that Meta was sacrificing its core business to chase an uncertain future. This pressure forced Zuckerberg to publicly acknowledge mistakes and shift tone, marking the first real sign that the metaverse vision was no longer untouchable. The year of efficiency was a quiet retreat. In 2023, Meta announced what it called the Year of Efficiency, a phrase signaling a major strategic shift. Tens of thousands of employees were laid off across multiple rounds, including teams connected to the metaverse development. Budgets were tightened, experimental projects were canceled, and hiring slowed dramatically. While Meta never officially abandoned the metaverse, Reality Labs' spending growth was reduced and internal priorities changed. Public communication focused less on virtual worlds and more on improving profitability and operational discipline. This wasn't just cost-cutting, it was damage control. The move reassured investors, but also confirmed what many already believed. The original metaverse vision was too expensive to sustain at full speed. A $30 billion lesson in tech overconfidence. Meta's metaverse gamble became a case study in what happens when confidence turns into overreach. The company assumed that scale, money, and influence could accelerate adoption before the technology and consumers were ready. Instead of allowing the metaverse to evolve organically, Meta tried to force it into existence. The result was a massive burn rate, declining morale, and shaken investor trust. While Meta remains a powerful tech company, the metaverse era permanently changed how markets view big tech vision projects. It proved that even industry giants can misread timing, human behavior, and cultural readiness. The $30 billion spent will likely be remembered not just as a loss, but as a warning about building the future too far ahead of demand. Meta's metaverse dream wasn't just expensive, it was a reminder that even giants can fall when ambition outruns reality. The company survived, adapted, and shifted focus, but the $30 billion price tag will forever be remembered as one of the boldest and most painful bets in tech history. If you enjoyed this breakdown, like the video, subscribe for more deep dives, and comment below. Do you think the metaverse still has a future, or is it already over?